Understanding credit scores and reports. A credit score is a number that tells a lender how likely an individual is to repay a loan or to make credit payments on time. The higher the score, the more creditworthy a consumer is considered to be. While banks and lenders use your credit score to determine your credit worthiness, landlords, employers, merchants, and even insurance companies also use your credit scores. Payment history accounts for 35% of your credit score. How long payments are past due and the amount that are past due are used here. Having a long history of making payments on time and no missed payments on all credit accounts is one of the most important items lenders look at. The amount owed on account is 30% of your credit scored. This measures the amount you owe relative to the total amount of credit available. If you are close to maximizing your credit cards, you will receive a lower score. Length of credit history accounts for 15% of your credit score. Accounts open for a long time will help your credit score. New credit accounts for 10% of your scores. Opening several new credit accounts in a short period of time can lower your credit score. The type of credit is 10% of your score. It is the number and type of credit cards you use. Your credit score is commonly known as your FICO score. It is short for Fair Isaac Company. It is the firm that invented the scoring system. The 3-digit FICO score tells lenders how good a credit risk you are. The FICO score ranges from 300 to about 900, with the majority of people falling in the 600s and 700s. Here's what different scores say about you. Greater than 750, an excellent credit risk. Between 720 and 750, a very good credit risk. Between 660 and 720, acceptable. Between 620 and 600, uncertain credit risk. And less than 620 is a risky score. The higher the score, the better your credit rating. The credit report is the financial information collected by the credit bureaus and used by the lenders to determine credit worthiness of individuals. The report contains personal and employment history on an individual. It includes payment history of all debts by an individual. It is important to note that credit bureaus do not make the decisions about your credit worthiness. They only supply the information. Lenders make the decision. 3 companies publish credit reports: Equifax, TransUnion, and Experian. You can and should regularly review your credit reports to learn what it says about you and to correct any mistakes. Your credit report will determine whether a bank or other lender is willing to loan you money to buy a car. It is also determined what interest rate you get. The same is true with credit cards. People with bad credit reports generally have to pay higher interest rates. A credit rating is a grade, generally between an A and an F, given to an individual by a credit reporting agency. The credit rating relates to an individual's ability to pay debt. It reflects past performance of paying debt. It projects future performance of paying debt. And a positive rating may allow an individual to receive lower interest rates for loans and credit cards. The best thing you can do to improve your score is to pay your bills on time. Begin by making at least a minimal payment on time. Late payments have a negative impact on your score. If you have been managing credit for a short time, do not open a lot of new accounts quickly. When you open several accounts, there is a risk of you using all of this new available credit. The new available credit could lower your score. If your credit report contains negative information, it will negatively impact your credit score, regardless of whether or not the information is accurate. Review your report for accuracy once a year and before applying for a loan. Keep balances low on credit cards and other revolving credit. High outstanding debt can negatively affect a score. Pay off debt rather than moving it from one card to another. A bad credit report can cost you, so it makes sense to keep it good.